fourth rebranding that I've seen since I've been at the firm. So I guess we're going back to blue. But so we could probably, are you open?
Are we still waiting?
Yeah, I am just waiting for technology IT to tell me that we're live. Okay. Yeah, we are.
So welcome everyone. This is Christina Bennett, Investment Chair for the Public School Retirement System. I'd like to start off the meeting today by a roll call vote. If you could, please, Sue.
Angela Banks,
Here.
Christina Bennett,
Present.
Joseph Clark, Lewis Cross,
Present.
Regina Fowler,
Here.
Sheila Goodwin. Sheila's here.
Here.
Donna Jones,
Here.
Yvette Levy. She wasn't able to attend.
Right.
Bobby Richardson. Albert Sanders. All right, let's see. We got a couple people in the waiting room, so let me let them in. Okay, so Albert Sanders
Here.
and Justin Stein.
Here.
All right.
Thanks. Thanks, Sue.
So we have 8, so we have enough for a quorum.
Thank you. I know we're on a tight time frame because I know Regina has to leave at 5:30. So I really want her to hear as much of the presentation as possible, and we pushed back the performance review to later in the meeting. So Kristen, with no delay, can you please start the presentation?
Absolutely. So Sue, maybe you can turn to the executive summary,
Okay.
which is the next page. So on the executive summary here, I just really want to give you the background of where we are on the portfolio. And what this is I'd like to think of it as an ongoing RFP from the perspective I'm going to present several firms for your consideration. I would also like to acknowledge that there will be a few additional firms that we would be bringing forward for your consideration in the upcoming months. But essentially wanted to, get sort of the ball rolling because we have about 45 million to commit. So let's just kind of backtrack here. Essentially, your target is about 7%. You're not looking to be able to get what I call achieve your target, if you will, until about 2027, which is fine. We like to do this over multiple years, and we've really just restarted the program from the perspective that where there was just some concerns about liquidity and how much could be done. And so, and then of course we had COVID, which did put, I guess, a temporary pause on things. But presently you have in the ground invested about 3.1% invested. Now, when you look at your private market reports, you'll see invested and then you'll see something that says total exposure. Your total exposure is closer to about 6% because we do overcommit in an effort to get to that total invested number, because as a reminder, the private equity is drawn down over time, not immediately. And so you really have to commit more than what you're trying to, you have to have a higher commitment, like double the commitment to try to get close to your actual target. Presently, right now, when you look at what you have in your portfolio, I won't go through all of the numbers, but if you can see that second bullet point, you'll see that you have about 4 different areas that are covered in your portfolio: buyouts, distressed, fund of funds, which is typically broad based and will have multiple sectors within it, as well as secondaries. So this is the numbers that you have presently in the portfolio. What you don't have is a lot of Asian investments, as we've mentioned, as well as co-investment. Those are areas that we really would love to see a little bit more on. Again, your program is mature. While we're not at our target, we still are have a mature program. What has worked really well for this committee in the past has been fund of funds, and fund of funds do have a slower drawdown. And so what I have done is a couple of things. We have updated your pacing plan, so I will show you that in a moment. But just as a preamble, you basically have about 25 million for 2021, and we're really half done of 2021, and then another 20 million for 2020. Because fund of funds really deploy capital pretty slowly, it you know, in talking with Eric Harnish, who many of you know is our private equity researcher that works with us on St. Louis specifically, you know, the thought was to really go ahead and look to do the commitments for 2021 and 2022 at one time. We think that that will give you a nice pacing to be able to span over those 2 periods, as well as get some really strong partners in here, meaning private equity partners, and then we wouldn't be worried about doing it again next year. We would come back in 2023, and so that just cuts down the amount of sort of searches, if you have to, if you will. And you know, some of the funds we think are really strong, and they won't necessarily be out next year. They'll be just closing. So I wanted to give you the background as to why that dollar amount was at 45 million. So really what we're looking for today is for you to commit about 2/3 of that potentially today. When I say commit, I mean look to evaluate the managers and bring them back for interviews for consideration of about 75% of that, with a remaining 10 million being left out potentially for a few other managers that will be coming down the pipeline. So that gives you an idea. That was a lot. I don't know if there's any questions, but that's really what that 3rd bullet point is trying to articulate. Are there any questions? Okay, if not, then I'm going to continue. So there are 4 firms that we have for consideration, some of which you have worked with in the past or are currently working with. So Asia Alternative, which is a fund that's focused on Asia Pacific buyouts. It has venture capital and growth equity. This is a fund that's 1 rated. We really feel strongly that this fund should be considered, in particular because you do have a gap as it relates to Asian investments. Now, we did just do a little bit on the private debt side, but don't want to confuse private debt with private equity. So really the same theme is relevant here as it relates to the fact of where GDP is going, where the contribution of Asia is going to be towards global GDP, and the fact of not wanting to or wanting to have exposure to that opportunity set. So that's one opportunity that I'm presenting today. The second is called GCM Grosvenor. Now, you are working with Grosvenor presently on the hedge fund side. And so this is a fund that, again, is highly rated at NEPC, focused on U.S. buyouts, growth equity, and minority-led PE strategies. But the biggest piece of this is, well, there's 2 big pieces. One, which I think strategically would be really a value add to your portfolio, is this 40% co-investment. And that co-investment gives you the opportunity to invest directly with companies, really alongside really the private equity firm. So not just within the fund, but alongside. And so that's a great opportunity for you all. And it also lowers the fees. And the bonus for this particular investment is it's the advanced fund, which actually is or focuses on diverse-led managers. So that brings a nice piece there. The third opportunity is Mesirow. Again, U.S. European buyouts has a bit more venture and growth equity. This is a manager that has done very well for you all previously. You worked with them before, so it's not new to PSERS. I know there are some that are new to the board, but this is a firm that you all have already worked with. And then the last firm is Private Advisors, which is a U.S. lower middle market buyout and growth equity. Like them as well, I would say, you know, and I'm going to go through all of these in a little bit more detail, but I would say, you know, top three would be, you know, my stronger recommendations. Private advisors is wonderful. I would only, you know, recommend you slot them in if you were not comfortable with doing the Asia alternatives. Because I do think that you get some of the exposures already with Mesirow, which, as I mentioned, would be you know, a continuation, or not a continuation, but an organization that you've already worked with that's done really well with you. So that's just continuing a partnership that you already have. GCM Grosvenor, again, with that co-investment coupled with a diverse component, minority owned and women owned component. And then Asia really adds to that piece as it relates to the gap that I see in your portfolio. So again, all four firms are wonderful, but I just wanted to delineate them in that manner. So maybe we can move to the next page. These are two firms that we're doing a little bit more work on and would be looking to potentially bring forward in the future. So I just wanted to kind of sort of hone in on the fact that, you know, this isn't it. This is a portion of a search, but we really want to make sure we are able to get into these funds at, you know, before their closings, and get any sort of, you know, favorite nation type of fees or what have you, if as it relates to early investors, if those are applicable. So with that, what I'm doing with private equity and with real estate, and you saw it a little bit with private credit, is bringing them as they come versus waiting, because we might wait and something closes on us, and we don't want that to happen. So there's often there's a misalignment with timing, and so when there's great
Excuse
ideas.
me a minute, Kristen.
Yes.
Is Fairview Partners, is this a Fairview Capital Partners or is this another Fairview?
Yes, Sheila.
Yes, Fairview Capital Partners.
Okay, thank you.
You're welcome. So those are to come. So what I'm recommending is, you know, structurally, that we hold out another about 10 million of that 45 to be considered between these two firms. Okay. So maybe we can move on. And this is, I wanted to just talk about the pacing plan just a little bit. You've seen all this before, but what we did was, because the dollars amounts and because of the market correction that we had after COVID. So if you remember, we did your pacing plan in November. We were still coming out of COVID. I mean, we're still coming out of COVID, but, you know, I think there's more certainty around, you know, where the market is going at this point, albeit volatility is there, but there is a bit more certainty. And so we had ratcheted down the private market recommendations in November due to potential liquidity concerns. Now that that is not necessarily a concern anymore, we felt comfortable ratcheting it back up to what it would have normally been. But again, we wanted to take a more conservative approach in November. But given where we are now in May, and we see how the markets have continued to perform, and how liquidity has continued to be within the market and easily accessible, we don't need to hold back. And so with that in mind, that's why your dollar amounts went up just a little bit. Okay. And so that's what you can see. And so just as a reminder, the dotted line is sort of that overcommitment that I talked about. The red line is where you want to actually get to. Green is going to be sort of investments that haven't been called. So those are, you've committed, but it's sitting in your portfolio, has not been called. And then blue, the dark blue, is what has actually been called and is in the ground, that is actually working for you. And so when it becomes shaded, that's, you know, whether it's blue or green, that's what is anticipated that you will either commit or will be in the ground. And so if you can scroll over and see that 2027 is where you really get fully invested. So it's going to take a bit of time, but that's understandable. We're comfortable with that. It means that you'll have vintage year diversification, which mitigates risk when we think about this asset class. So I wanted to show you that. And if you can go to the next page. This next page just gives you a cleaner look just at those commitments. So if you can see in 18, you were at 15 million. 19 and 20, we actually didn't make any commitments. 2020, mainly because of COVID. So that was really where that flip was. We would have otherwise done investments earlier, probably rolling out of 2019. So 2019 was really the year that we ended up skipping. 2020 was really as a result of COVID. And so we did want to hold off a bit given the volatility of the markets, and nobody knew. We weren't sure if the world was coming to the end or not. So with that in mind, you can see where we're able to do a little bit more here, a little bit of a catch up, 25 in 2021, and then 2022, the 20. So that's where that 45 million comes from. Okay. And so some of these funds will, like I said, be having their final close in 2022. So that's really what I wanted to point out on that slide. And maybe we can go to the final slide. And this just, again, is another way to articulate when you actually get to that total, it says 6.9, but really 7%. So that was just a review on the pacing plan. Are there any questions? Okay. So maybe we can now focus on the next page. So this is, really just the profile. I've talked quite a bit about this already. This is the Asian alternatives. Couple of things. When we talk about Asia, it's not just China. So if you look in the middle box, you can see that geographic focus. I know that was a question before. So this is Asia and Australasia is how they categorize it. So there is China in there, but there's Australia, there's New Zealand, there's Korea, Japan, Hong Kong, and other parts of Southeast Asia. So it's not concentrated just in China, though we do feel like China does have some great opportunities at this point. The fund size is going to be at about 1.8 billion, and they've already raised 1.6 billion. So this is an example of something that is going to close fairly, soon. So it looks like June. I'm going to need to check actually, because we may have to kind of expedite that because they're getting pretty close to their closing. But I wanted to kind of bring this forward to you.
Kristen, do you know if they're mostly, Asian or mostly like New Zealand and Australia?
I think that Australia is probably up to about 20% is what we've seen in the past.
Mm-hmm.
And that would be Australia and New Zealand combined.
I see. Okay.
Mm-hmm. And then you have, Japan, India, which I did mention before. Yep. Mm-hmm. So in addition to China.
Okay.
Yeah, so Kristen, if this one is closing in June, we wouldn't have the board meeting to approve any possible recommendations from the investment committee until June 21st. And we do typically allow 60 days, for all the paperwork and so forth. So
what I'm going to do is find out if this is a hard, because they're oftentimes not hard. Eric actually put this forward for us. I don't know if you've met, or many of you have met Eric Harnish. So this is his space. So I will double check on that, because he's very familiar with you all's nuanced needs. So I'll make sure that we're, they're going to still be open, but this would be, as long as we can get that commitment in and have the time. They may potentially just wait for the, if they know that there's a commitment coming, the negotiation. So that's not uncommon.
And maybe Matt can tell us how long it would take for him, but let's just assume, let's just keep going and just, this might, be put on the back burner, but let's just keep moving to the presentation.
Absolutely. And like I said, I'll email Eric shortly. So the other thing I'd point out is that it's at 8% preferred return. As a reminder, what that means is that you get 8% of your money back on top, you get 8% return, I should say, not money back, but return before there's any sort of profit sharing. So that's very typical for private equity and private markets, but I did just want to highlight that their target net IRR is between 20 and 25%. So this is going to be a bit, if they produce as they have produced in the past, is a relatively high flyer. Are there any questions here?
What do we contribute, like 10 million or 15 million to these funds over time, or is that what we're
Sure.
doing? Okay.
For this fund, if as long as they are open, I would recommend 10.
10 to
Slightly
8.
higher to the two others, 12 and a half to the two others that you potentially could go forward with. And again, this is all based on approval and acceptance of the recommendation, but
Mhm.
so Regina, in general, your commitments are anywhere from 10 to 15 million.
Well, remember we did, Elm Tree, we did 8.
Yeah,
So we did 8. So we have the flexibility depending on what other things we want to look at. But typically 5 increments of 5 or 10, and sometimes we do 12 and a half. Rarely do we do 15.
okay, we can move forward to the next one if there are no other questions. This is just going to be the performance. So I'm assuming y'all have already, taken a look at this. Again, their ranks are very high. So if you look at their quarter ranks for their net IRR, which is in the middle, TPVI is total value paid in capital. But for your purposes, I think the net IRR would be the most plausible there. So we can move on to the next one. This is GCM Grosvenor, the Advanced Fund. As I mentioned, it is focused with diverse managers. These are not necessarily new managers. Grosvenor has had a long track record of investing with diverse managers. And because of client demand, they determined that they wanted to create a program that focused, and that they pooled all of their diverse managers in. So it's going to be across multiple sectors and industry focus. So that's why it says diversified, and it is US based. And they're looking for about a 20% net IRR over time. Also have an 8% preferred rate of return. This one is going to be a smaller fund. So unlike the Asia fund, which is at 1.8 billion hard cap, this is about 500 million. So a bit smaller, a bit more nimble. Again, rated high with NEPC. They're going to have about 12 to 14 commitments that are primary, and then another 12 to 14 commitments that are that co-investment that I talked about, which is very attractive. That's something that you don't have as much of in your portfolio. Any questions?
I think, Kristen, what I'd like to highlight is that Grosvenor does focus on diverse private equity managers. And that really adds to our core of what we want to look at and make sure that we include in all of our searches. So I just wanted to highlight that footnote down at the bottom for their prior track record fund.
Absolutely. So maybe you can toggle forward, Sue. So this is gives you an idea of kind of where their performance has been, and when they've been the first quartile. So they are a performer also, which is what we expect. Okay. Any questions? No questions? I see you looking at me, Bobby. Wasn't sure that was you.
Yeah.
Okay.
Kristen, I think I have a question.
Yes.
Just trying to learn more about this, but the IRR is the initial rate of return?
Internal rate of return.
Internal. So they're expecting to make 29%, 25, 33%?
Yeah.
Oh, no.
I'm sorry.
They want to make 29% and they pay 8% return.
No. They're anticipating, or their target return for this fund is 20%. But because of the nature of private equity, the general partner shares in the profits. They do not share in any profits until you have received at least 8 of that 20%.
Oh, okay.
So it really aligns the interests.
I got you. Well, thanks.
Great question, Justin.
Good one. Learning.
Well, that's what this is about. And maybe we can move to the next one. So Mesereau Financial, again, another firm that you've actually, it's a diversified fund. This is a fund that, or an organization that you have worked with before. Strong track record, done well for you. So this would really be a continuation of a partnership. Their target return is 11 to 15%, so a little less aggressive, I would say. They're and one of the reasons that they wouldn't be as high as Grosvenor's, they don't have as strong as much co-investment. The co-investment has a higher return profile, as an example. But as you can see at the top, they do have some co-investment, but mainly primaries and secondaries, which is we're very comfortable with. We like secondaries in your portfolio. It's a way to tap into investments, in particular that may be from vintage years, previous vintage years. So this also is right now they're at about 440 million. They're not going to probably close to the second quarter of 2022. So this is my example of how some are going to be closing sooner than others. And so our commitment, we would make that commitment, but this would be deployed over time, over the 24 months. And potentially longer, but we wouldn't need to come back to the market to start looking at new managers until 2023.
Kristen, this is Lewis.
Yes.
You said 11%. What's the max on their 11% is a guarantee, and then it could be up to what?
No, so it's never a guarantee. So let me correct that. But it's they have a preferred return of 7%. So you get 7% of your return before they participate in any sort of profits. So that is, we like that. And then their target net IR is between 11 and 15%. So that's what they're anticipating getting. Now, if you look at some of their funds from 13 and 18, they surpassed that at 20%. And I think they've actually surpassed that in the portfolio you have. That said, typically they will give a conservative estimation of what they anticipate netting to you.
Okay.
And I think, Kristen, what I like about this fund is that we're getting some exposure here to, let's say we can't do Asia, and Asia's not going to be a opportunity for us because of their close date, but we are getting, up to 10% of Asia Pacific, and ROW means the rest of the world. And so while we're getting additional co-investments here, we're complementing somebody like Grosvenor, but we're also getting that percentage to Asia, where it's not as high as the Asia alternative ones, but we are getting in these funds of funds exposure to Asia. So we're not totally out of the Asia market. We're just not heavily concentrated in some of these funds. So I just wanted to bring that to the attention.
Yep. No, that's a great point. And like I said, I'm pretty sure though, I'm going to triple check, but Eric would not have put something forward that's closing in 30. He shouldn't have. He knows what y'all's process is. So,
Can I ask a question? How do you guys choose the fund? I want to be transparent. I just saw that HarborVest was a future fund, and my husband is managing there. So I just want to make sure you're aware. But how did the board go through a process of choosing the fund, or does your firm just choose the fund?
my firm vets lots of funds, and we come up with a pipeline of funds that have bubbled to the top. So as an example, HarborVest is actually a firm that we have worked with quite a bit. We have a lot of client exposure. They have bubbled to the top, not because they've had client exposure, but because they've gone through a heavy due diligence process that NEPC does across firms. And so we rate firms. And so HarborVest, I believe, is actually a 1-rated firm as well. And so we rate each fund though. So it could be this year HarborVest has a one rated fund. Next year, maybe we don't like it as much for whatever, there's always, because we dig back, we go under the hood, we're peeling back the onion, but we go through the performance are going to be, we look at the,
Yeah, we're you're going in and out a little bit.
something happened. Can y'all hear me? Okay. Yeah, okay. Where was it? Yeah, we look at the performance. We look at the performers. We look at the portfolio managers. We look at the sectors they're going to go into. We also look at what strategies they're using. So for example, for a very long time, we're just coming back to liking venture. So you may have been the best venture fund out there, but we just really, the venture went through about a 10 to 12 year period where it just was not performing. And so we just didn't see the value add in that. And so that also will dictate some areas. And then we look at the pricing. So one of the things we always try to make sure is that our clients get the best pricing. And so many of these organizations that have worked with us, one of the pushes that NEPC is known for is really pushing the pricing down a bit, or trying to aggregate all of our clients' accounts so that our clients can get the best pricing. It doesn't do anything for us, so it's completely passed on, but it's just, we feel like, hey, if we've got all these clients in your particular vehicle, we want to get up, we want to get them some breaks here. So that's kind of what the process is. And quarterly, we come with, we have a quarterly pipeline report. Sometimes it comes out more frequently because we have, funds that we're looking at, and you're probably familiar with this, but in particular in the private markets, it takes a lot longer to do that due diligence. And so, we're constantly trying to go through the process.
Was more, how involved are the board members in evaluating the choices you guys made, or do you guys does the board?
So Regina, I'll tell you, Louis and I have been on this board for a long time. So I think we both came on at different times in 2005. Right. So myself being an investment professional, and I just left a firm that was a hedge fund to fund fixed income alternative. So I've made recommendations over the past, like, hey, why aren't we looking at so-and-so? Or why aren't we looking at X, Y, and Z, or A, B, and C? Or, hey, you know what? I met somebody at a conference and I really liked their fund. Kristen, would you consider thinking them next time we do, a search for whatever strategy? So I know that I've recommended to exhaustion a bunch of firms to Kristen. Some of them come through, some of them don't. And sometimes some of them don't make the cut through NEPC's strategy. But for example, I'll give you Elm Tree, which is a local, and they're real estate. It took them 8 years of us working with me, recommending them turning around and doing their due diligence. They went through 2 funds, and we finally were able to have the analysis done by NEPC to get a rating in order for them to recommend. Sometimes we've asked to be able to see a firm. It may not be a top rated firm or a minority firm that doesn't have the 1 rating like Mesero does, but we want to see them anyways. Kristen will bring them to us and show us the comparisons. And that's how we ended up with a fixed income provider that now has, I think, been incorporated into Exponents. So whether it really depends on the appetite of the board and the collective discussion of the board at our meetings.
Okay, and I mean, that's what the concern I was having, is the board was somehow involved in the process. Obviously, we ultimately have the fiduciary responsibility for the funds. And then I guess another question I have is, do you guys has there ever been any discussion about, the type of funds or type of investments that we won't participate in? Like certain not-for-profits have, like, we will not support any kind of investment here or there. Do we ever have any conversations like that at any time?
I missed that whole section, so I'm sorry.
Well, yeah, I guess Kristen can answer
Yeah,
that.
so she's just looking for things that you all would not invest in historically, which is sometimes challenging with private markets or alternatives. will not invest in any entities that are originated or incorporated in the Cayman. Like they have to be like Delaware or somewhere in the U.S.
Okay.
That's and that's a nuance. You know, we don't see that often, but that is a specific nuance with St. Louis that y'all, you know, it just isn't happening. And so that was something that I know Eric made sure that there was an office here in I think it's in California for the Asia Fund, because we've already been down that path. And so want to make sure that, you know, everybody's comfortable.
Okay, thank you.
Mhm.
And Regina, our guidelines will tell us there's certain things we cannot invest in. So
Okay. I think I was pretty much finished with Mesro. Did you have any questions about Mesro? The track record is stellar. Okay. The last fund is private advisors. So this is a North American based fund, again, has done very well. Smaller fund again. So you notice all but the Asia fund are somewhere between 500, 400 million. We like more nimble type of organizations. They have, again, they have a preferred return at 8%. They're looking at a target net IRR of 15 to 17%. They're focused on a bit of the lower middle market buyouts. So a little bit more narrow than some of the others that we've been looking at, but they do it very well. So it's still diversified, but they are, from a strategy standpoint, they're downtrending. So there's value there. On the private debt side, you have Monroe Capital that does that same lower middle markets also. So just, you know, that is a place that you have played in the past.
If for some reason the first fund, going back to the name of it,
Asia
Alternatives, yeah, if they don't come through, will we go through a process where we can maybe have a little bit more invested in the Asian funds, or?
So we can look. So
Okay.
let me check again. Like I said, Eric, I would be very surprised if he put forward something that was closing in a couple of weeks, because he knows that y'all's, you know, process, but maybe we just, you know, missed that. My understanding was open longer, but, you know, again, some of these closings, they do these profiles and then that changes. And so I'm going to just double check that. But, you know, with GCM and Mesro, even if the Asian alternates doesn't come through, we can still look to see what some other options are.
well,
Okay.
and Kristen, I just want you to know that, you know, I've been looking at Harbor Vest for years. And they do have, so if we couldn't get into Asia, which we can table that for now, but they have a global fund that has maybe not as much Asia exposure, maybe 10 to 15 again, or
Right.
rest of the world. But if we did those three, right, which we won't make a decision today on that one because we don't have the numbers, then we would be getting maybe, you know, 20 to 30% Asia through three combined funds. If we can't get, you know, the other one.
Exactly.
Yeah, I just want to make sure the board is clear. I'm not trying to push our best, because I actually, until I saw the report, today, I didn't even know that their name was on it. So.
Yeah.
Note taken, Regina. I'm pushing it. You're not.
All right.
I'm very familiar with Melissa and her team on what they've been able to do over there. Not, you know, just because your husband works there doesn't mean that, you know. So I just wanted to make that point that my contact has been with Melissa.
Okay.
So I'm pretty good with their numbers. I've seen them over the last 2 years. So I just wanted to put that on record.
Okay, thank you.
Okay. So I think all of those are great options. And again, like I said, I really put private advisors. I mean, again, they're a wonderful firm, but I put them there in case you weren't interested in Asia. It sounds like you are interested in Asia. So with that in mind, I would recommend that the first 3 managers you consider bringing forward. I've already sent Eric a message. And so if for some reason Asia Alternatives drops out, we will, we already have a backup sort of workaround with what we'll get in Mesero and potentially looking at the Harbor Vest. Okay.
So so you're recommending that we do the first 3
Mhm.
for our next meeting for presentations?
Yes. Yes.
And then, but what if the answer tomorrow on Asia is no, then is it possible to throw in the presentation along with the analysis for Harbor Vest?
Say that again. If
It may be a longer meeting in June, but I
let me
would
just make sure.
recommend 4.
Okay.
That way, if Asia falls out, we still have 3.
Oh, okay. I see what you're saying. Yeah. Yes, we should be able to do the profile for Harbor Vest if you all want to bring them in as well.
What amount recommend?
Louis, you're breaking up.
Oh, I said, what amount are you recommending for each of the companies?
It's going to depend a little bit on how many we actually choose. I would say anywhere, I think it's going to depend on whether the Asia alt ends up being there. For this first tranche, I was thinking somewhere around 10 and potentially 10 to 12 for the other 2, and then leave another 10 to 14, depending on how much you did with the other two being GCM and Mesero for Fairview and Harbor Vest. But if Asia, so it's a little bit dependent, but I would say around that amount. We will adjust accordingly depending on if Asia alt falls out. Okay.
And Kristen, the date of the investment committee is June 17th.
Okay.
And then the regular board meeting is the 21st. So we could.
Well, yeah, so that's great because
recommend
that'll
and
mean
then
we'll have everything ready.
Mhm.
And it doesn't mean that if I apologize, that if Asia alt stays in, that Harbor Vest is out. We were still going to consider them. The only one that I was really was more of a backup in this particular search was the private advisors. That makes sense.
Yeah.
So then,
I'm gonna be honest. I'm not a big fan of investing, 10 million in Asia fund. My preference is to invest as least as possible in the Asian fund because we haven't had a global Asia market study to understand what's happening in that economy in that area of the world. And I know that we could get Asia exposure with other funds, but not the amount of exposure we would have in this fund. So that's my personal opinion.
okay, so just so I'm clear, are you suggesting that we take them out, or are you suggesting that we just ratchet down that amount to maybe set 5 to 7?
Whatever the preference of the other members are, but
I would like to
I
hear.
don't want to exclude
Oh, yeah.
the global equity of Harbor Vest. If I can get 3 rated 1 funds as opposed to this one that I'm not familiar with, then it just depends what other people are thinking.
Yeah,
Um,
well, I would highlight though that I do think the way Asia alt does it is a little bit different because they are a special list. But acknowledging that reticency, I would suggest for consideration potentially not doing 10, but maybe looking at them if they're open for 5 to 7 and still going into Harbor Vest and Mesero. Because I think they're going to approach it a little bit differently.
On the,
Okay.
on the
But that's
17th
just,
oh, go ahead. On the 17th, we're going to hear from all these firms, right?
yes.
Okay, I would like to just hear from Asia Alternatives on that day as well, but have that backup there also. So if we can hear from Asia Alternative and the other two that you're recommending, but then also hear from, you know, if it's ArborVest or someone else that could get us into some Asian funds. So that we can hear.
I'm not a fan of Asia, but it's not quite clear yet. But I don't think I'm ready to put 10 million with them either.
That's
Okay.
fair. Yep.
And Christina, just maybe you could help us. And Kristen, you know, I've just been kind of reading up and you know, on Asia, what's happening over there. It just seems like that's going to be such a growth area that, you know, and private equity is a tough business, you ask me. But if you're going to make it big, you know, I think the bigness is almost in the risk. And even though Asia seems risky today, it just seems like they're growing so much. They're growing at a faster pace than the U.S. seems to be growing, of course. And I would hate to miss out on that. And how we do it, you know, is something that we have to consider. And that's why I would like to at least hear from the Asia Fund, just because I'd like to see what their strategies are and how they.
Absolutely. I think that's a good strategy. I'd like to hear it too. But I
Yeah.
think, Kristen, in the interim, from this meeting to the next meeting, if Asia is able to go forward and we're not going to get cut out from any potential closing, then maybe some type of market study that you can send us, or some focus world information you can send us, so that we can read upon it before they present. So we have a little bit more idea of what's happening in that region of the world. You know, before we make, you know, an investment at this magnitude in there.
No, actually happy to
That's
do
a
that. I
great
mean, like, I think that, you know, when you think about it, Asia, per what Regina just mentioned, in the next 10 to 15 years, they're going to be close to 20% of GDP of global investments. So it's a huge, I mean, they are growing so rapidly, which is why, you know, you're starting to hear more and more about it. I don't think that all Asia funds are equal. I don't think all Asia or Chinese investments are equal. I do think you have to have a balanced approach. But that said, you know, let's see what they have to say. You know, if there's a comfortability recognizing sort of the risk appetite of this group, I would, you know, recommend paring back, because I'm hearing you, I'm listening to you all. I would recommend paring back that 10 to maybe 5 to 7 to still be able to get some of that, like, you know, concentrated exposure, but then still do some other opportunities that, you know, don't take you over on the risk appetite. But let's see what they have to say.
Little
I agree.
clarification here.
Kristen, I had a question.
Yes.
So are there videos that these companies produce that kind of introduce you to what they're doing?
Okay.
I don't know that they're videos. I do know that they'll come on and they will answer any question that you have. And so, I mean, I think, you know, potentially having some information or idea of what either you're concerned about or what you want to learn more about during the presentation will be helpful.
A little clarification here. When we talk about the Asian market, what countries are included in this?
China, India, Korea, Japan, Australia, New Zealand. I think I covered India. I think I said that. Yeah.
India. Okay. Okay. I asked you because in the discussion, I've heard Asian, and then it appeared as if they were talking about China separately and Asia separately. So China is part of this Asian group?
Yes. Yes. China, Japan, India, Australia, New Zealand. you know, sometimes Thailand, Taiwan, but in this case, I think Korea.
Okay. All right.
Did we want to move
Sorry about
to,
that.
are we done with this part, Kristen, or,
I think so.
okay, do we want to go into performance? Because I know Regina's got to jump on.
Yeah, I can do that pretty quickly. So, you know, I'm going to just hit the high points here because I know, we've spent a lot of time on this, so I know you all have already gotten this. So maybe we can toggle forward a couple of slides. Actually, just take a step back. I'm sorry. Just high level, what you need to know is equities were up. Fixed income did not do as well for the quarter. The US dollar was up and volatility was down. Now, when we get into April, the US dollar did depreciate a little bit. And so you had the non-US markets did perform a bit better. So for the quarter, US outpaced non-US. So that's just something that you should know. You know, the fixed income market and the treasuries, it has flattened out in April, but really that was a bit steeper. So you were getting paid for being out longer on the curve. You know, the Fed is continuing to sort of hold tight. They have continued to maintain their purchasing power of the market, so we don't and unemployment has actually gone down, so that's something that has been helpful to the broad macroeconomic backdrop. So maybe with that we can go forward.
I have just a question, and if you think it needs to be deferred to a later time, that's okay. You know, some are predicting that we're going to have some high inflation coming soon. I don't know if that's true or not, but how would that affect our investment portfolio, or do we consider that as we move forward with our investment portfolio?
Well, that's why we have things like tips in the portfolio that will affect, you know, the fixed income, of course, and potentially could have an impact on, you know, equities. I mean, when you see the numbers that you've seen, we do not think that those are sustainable over time. It's been great, but and we're going to take it, but really, these have been unbelievable performance numbers that we are seeing posted. And so, yeah, it could have an impact on purchasing power, right? But while we expect there to be some spikes, I don't know that we think it's going to be draconian, like just out the roofs. I mean, there is volatility there, so we do have to kind of wait and see. But that goes back to sort of this permanent intervention kind of theme that we have around monetary and fiscal policy really holding things tight. If everything was just left, you know, to kind of go on its own, I think we would have been a very different story. We also probably wouldn't have had the longevity of the late cycle that we had before COVID. So, and then the fact that it's bounced back. But you know, we are continuing to watch it. So right now we're not in a deflationary environment. Very low inflation, interest rates are low as well, but there's some anticipation that this is going to uptick. So that's, I think, expected and baked into the numbers already.
Okay, great, thank you.
When we look at your performance, you know, you're at 926 million. And very importantly, I think just looking at where your rank is, pleased to see, you know, over the 3 months, you're in the 29th percentile. Looking at your 1 year performance at 36th percentile over the time period, that's amazing performance, but it still only places you in the 52nd percentile. So that's interesting, I think, to have those level returns. I think we take it. The areas that were challenged, in particular in the equities, you know, the the indices were doing extraordinarily well. They were in the top quintile, so the top 5%, which normally the index is in the 50th percentile. Now, you know, you might even say that at your 3 years, sitting in the 91st percentile would be poor, but I look at the bigger picture. At 8.6%, you are more than meeting your actuarial rate of return. And so I think that while we want to be, you know, in the first percentile, I think we just don't want to lose the bigger picture here, because you could be in the first percentile and be at 2% return. So, you know, because it's all relative, right, on what's going on. But as we know, the last several years, the indices have been doing very, very well. And so that's really what I wanted to highlight here. And if you look at the longer term 5 years, you can still once again see that you are beating your actuarial return by several hundred basis points. So that's, I think, good news for the fund in general. Maybe you can turn to the next page. This is always just a check that we look to make sure that we are in compliance with what we're trying to do. Private equity, we're looking to try to address that, as well as the non-US equity developed. Those are areas that we're slightly under, I'm sorry. And so, you know, we're not, you know, we are recognizing them, but we're not making any knee-jerk reactions. So we're pretty good in the policy perspective. You can move forward. I'm probably going to have you move forward a couple of slides. Yeah, you can keep going. Keep going. You can keep going. Okay, so this, just to give you an idea of kind of the underlying managers and where we're looking at and where things are not maybe as strong as we'd like to see them. So you can see that your index is right where it should be, right? So maybe go to the next page so we can see some of our active managers. This is where the challenge has been. The active managers have just not been able to keep up. They're performing, you have positive returns, but they're just trailing the benchmark. And so when you look at your due diligence report, you're going to see that a lot of the managers look as though they should be put on watch. I would argue that we do watch them, but we need to recognize the type of market that we're coming out of over the last 12 months. It's been extraordinarily tumultuous, and the index has done better than active manager during this period. We don't anticipate that being the case going forward. As more volatility gets into the market, not just going up, but more volatility, you'll start to see the active managers being able to provide more value. So maybe you can move forward. Oh, yes.
I think it's in other funds you're managing as well then.
Say that again.
You're seeing this in other accounts you're managing as well then.
Mm-hmm. It's across the board. Mm-hmm.
Hey, you guys, I am going to have to get off. Thank you so much. I appreciate it. Okay, and I'll talk to you guys soon.
Bye,
Bye-bye.
Hi, Regina.
So just to continue, I mean, we'll look at the small mid cap. I mean, you have Westfield that did not, you know, that's in the 63rd percentile, but they generated 89% return for you over the last year. So that's what I mean when I say like just outsized returns and just very difficult keeping up with the benchmark. The Russell Growth performed at 90%. So I don't know if there's any managers I really wanted to highlight. Maybe we can go to the fixed income. So maybe toggle forward to the next page. Yeah, so this is where you all did pretty well on your fixed income, but you at 12.5%. You can see your corporate numbers are not as high. So Ernest, and when I say corporate, I mean your Barclays Ag. Now, who actually blew the cover off the ball would have been Exponent. So kudos to them. They're #1 ranked. They did an outstanding job avoiding the pitfalls that many of the other strong managers fell into. So that's what helped to drive your number up to 12.5%. Maybe you can go forward. Your tips added value, you were able to get 7.6% return from your tips, which is outstanding. Again, we're in an index fund because we didn't feel that we needed to take the active management on this, but that's what we're seeing. And then, of course, the global multi-sector and then the EMD blend, those are going to be areas that trail a little closer to what equities are doing. So really, EMD blend at blended at 17% is very close to what we normally would have seen coming from the equity market. So you can move forward. GAA, we talked about them, and we're going to be moving forward with GMO and PIMCO. But again, strong performers. So it looks like we've made the right choice when you look at the 3 over time. You can move forward. So the hedge fund, interest is showing very negative, but we're pretty much out of that. So I think that's just residual. That's not even really being actively managed. So we need to see when that's actually going to get turned over. Now, Whitebox and Grosvenor, Whitebox did really well. Grosvenor struggled just for the 3-month time period. It's hedge funds. It's a diversified basket, so it's not exactly surprising that there's going to be volatility. We're going to be looking more at the longer term numbers. And so when you look at their 1 year at 25%, they're doing exactly what they're supposed to be doing. So the small blip that they had in a 3-month is not concerning. Can we move forward, please? And so then the real estate, private equity, private debt, and those are really best looked at when we look at their IRR. So we can kind of turn to the private markets report if you like. So for your private debt portfolio, I'll just go over high level here. Since inception return is 7.61. So that is exactly where we want to be. And remember that that is really giving your credit component of your portfolio a little bit more robustness, if you will. It does still provide typically quarterly income, throws off income. And then of course your private equity over time since inception is 10.45%, and your real estate is 23.75. And to Christina's credit, we talked a little bit about Elmtree. Elmtree had a lot to do with that high, being able to contribute. They had such a strong fund. So they really blew it out with that 63%. So that's what helped you get that 23.75%. So that's high level. I don't know if you want any additional detail, but I wanted to just touch on all the core points. Any questions?
Very well done, Kristen.
Kristen, the only thing I wanted to mention is what we didn't talk about, why we pushed Fairview out. And the rationale for that was because we didn't have the full-blown NEPC analysis done.
Yes.
Correct. And so if you could just elaborate on that, and just because we left that hanging out there with the bullet point but never addressed it.
Sure. So Fairview is a manager that we know well, but we just, our research, as we mentioned, it takes a while to really work with these and get the due diligence completed. And so Fairview was not completed at this point. And so, but we have confidence that we will get completed on it, and that they are a viable option for your portfolio. And they are also a diverse manager. And so that just goes back to the point of just kind of a continuation. So don't look at this as one point of time. And, we're going to be having the conversation over multiple months as we continue to look at great opportunities. And it'll be the same thing as we look into real estate as well. They're not all going to come at the same time. Any other questions?
I think very excellent presentation, Kristen.
Okay, great. Well, thank you. I have my marching orders. So
And before we go, we have Matt here, before we finish up. He wanted to give us a report on where we are with the Cray Hill investment that was approved by the trustees.
And one moment before we go to that, Sue, I apologize. Eric Harnish just texted or emailed me back, and Asia Alternatives is available until September. I knew, but I just, I was like, I know he didn't do that, but I wanted to double check. So we'll still bring in HarborVest, because in my mind, it was not Asia Alternative or HarborVest. Potentially it was and. So. Okay.
All right. So we won't miss on anything. All right.
Okay. Thanks, Kristen.
A pleasure.
Yeah, so Sue indicated there's, like I said, we're completing the legal review regarding Cray Hill Principal Strategies Fund 2 limited partnership. There's some legal items I want to discuss with the trustees about that. So I recommend we move to closed session on that. And so I don't know if Sue, do you have a motion prepared on that?
I do.
Okay.
And Sheila, if you would do me the honors of reading that motion, because I'm not available to see the screen at the moment.
Did she hear you?
Here we go. Can hardly see it. I'm trying to bring it up. It's so small.
You want me to do it, Susan?
Okay, ready? To close, make a motion to close the meeting, and that all records and votes, to the extent permitted by law, pertaining to and or resulting from this closed meeting, be closed under RSO 610.021, 1, and 12, for the purpose of having a confidential or privileged communication with the attorney regarding a contract.
I second Richardson.
Roll call, please.
Angela Banks,
Yes.
Christina Bennett,
Yes.
Lewis Cross,
Yes.
Regina Fowler, Sheila Goodwin,
Yes.
Donna Jones,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
and Justin Stein.
Yes.
Okay, so we have 8, so the motion carries. Let me just do a few little technical things here to get us off live.
Going into closed session.
Okay, Sue, let me know when we're ready.
Okay.
No. Just goes off of the public availability. People can live stream this meeting if they want, but a closed session. The attorney's got to talk to us about something.
Hey, Justin, you're not on mute.
Oh, sorry. My bad.
Thanks.
Yes.
Christina Bennett,
Yes.
Lewis Cross, Lewis Cross,
Yes.
Sheila Goodwin,
Yes.
Donna Jones,
Yes.
Yvette Lee, oh, she's not here, Bobby Richardson,
Yes.
Albert Sanders,
Yes.
and Justin Stein.
Yes.
Great. So we have 8 and the motion carries.
Thank you. At this moment, now that we're back in open session, can I get a motion to adjourn?
Sheila
I don't
Goodwin
know.
makes a motion that we adjourn.
Are we
This meeting?
live?
Second.
Susan,
Yeah.
are we live and recording?
Yeah, we're
Yes.
It doesn't say recording, it just says live.
Do I need to make the motion again?
I'm waiting for Sue to say we're back live.
Yeah, we're good.
Okay, Sheila Goodman makes a motion that we adjourn this investment committee meeting so ably chaired by Christina Bennett.
Very good.
All those in favor?
Aye.
Aye.
Thanks, everyone, for a great meeting, very in-depth discussion. I appreciate it. And we'll see everyone at the next investment meeting next month.
June 17th, right?
That's right. Take care.
All right, see you all later. Bye-bye. Have a good one.
Bye.
Thanks.
Take care.
Thank
Bye-bye.
you. Bye. Thank you.